Right now, as the market is fully active, Tilray Brands, ticker TLRY, is trading at $1.27 per share, down about 3% for the day. The stock opened at $1.29, briefly touched $1.31, but has since sold off to a low of $1.22 before finding its current level. This movement is happening on significant volume, already at 34 million shares traded against an average of 41 million, indicating a high-conviction move. But the immediate price action isn't the real story. While Tilray's investor relations team just put out a press release today, November 13th, about a new marketing collaboration for its pub beer brand with the Big Buck Barcade game, the market is aggressively selling off the entire sector based on news that completely obliterates that minor announcement. The expectation for Tilray has long been that it is the safe play in the cannabis space, the company that, under CEO Irwin Simon, would achieve profitability before full U.S. legalization, using its Canadian dominance, European medical footprint, and savvy craft beer acquisitions as a Trojan horse. The strong first quarter 2026 results reported back on October 9th seemed to confirm this expectation. They posted record Q1 net revenue of $210 million and, crucially, actual net income of $1.5 million. That news sent the stock soaring 17% at the time. Investors felt validated. The strategy was working. But here is the harsh reality check that the market is digesting today. Yesterday, November 12th, reports emerged that the U.S. Congress, in its latest spending package, included language that effectively outlaws the entire $28 billion hemp-derived THC industry. This is the loophole from the 2018 Farm Bill that created the Delta-8 and intoxicating hemp-derived Delta-9 market, a market that many, including Tilray, were eyeing as a pathway into the U.S. This isn't just a minor regulatory hurdle, it's a potential prohibition of the entire gray market. This move, reportedly supported by both anti-legalization advocates and, ironically, some state-licensed cannabis operators who want to eliminate the competition, fundamentally changes the calculus for U.S. entry. The cognitive dissonance is staggering. Just 2 days ago, on November 11th, Tilray itself released a statement publicly advocating for sensible regulation of this very hemp market, calling for a 10 milligram THC cap per serving. They were asking for rules, and instead, the government responded with a reported ban. This tells you just how disconnected the industry's hopes are from Washington's political reality. The optimism that fueled the stock since its October earnings report is now running headfirst into a legislative brick wall. This legislative nightmare is the context for today's trading. The drop from the $1.29 open isn't just noise, it's the market repricing Tilray's U.S. growth prospects, which just went from a matter of when to a matter of if. The expectation was that safe banking or rescheduling was the next step forward. The reality is that Congress just took a giant leap backward, targeting the one part of the market that was federally permissible. This makes Tilray's diversification into craft beer less of a smart hedge and more of an absolute necessity for survival. The recent news of expanding medical cannabis pricing in Canada or entering the Panama market is fine, but those are rounding errors compared to the U.S. opportunity that just got kneecapped. This is why the stock is falling despite what looked like a strong fundamental setup. The macro environment for this specific sector just soured dramatically. Now, let's talk about the other side of this trade, the short sellers. For a stock as volatile and discussed as Tilray, the short data is fascinating and defies the common retail narrative. The expectation is that TLRY is this heavily suppressed stock, coiled for a massive short squeeze. The reality, when you look at the data, is very different. According to Fintel's most recent data, the short interest as a percentage of the float is about 8.97%. That's significant, representing about 104.4 million shares sold short. But here's the key. That number has been decreasing. NASDAQ data shows that back in June, the short interest was over 206 million shares. By September 30th, it was 132 million, and by mid-October, it was 104 million. Shorts have been steadily covering, taking profits on the way down and closing positions. They aren't piling in, they've been getting out. The most telling metric, and the one most retail investors should learn to check, is the short borrow fee rate. This is the interest rate a short seller must pay to borrow the stock. If demand to short is high and shares are scarce, this rate explodes. For Tilray, the borrow fee rate is currently just 0.79%. That is incredibly low. It means it is cheap and easy to borrow TLRY to sell it short. There is no panic, no scarcity, and no squeeze pressure from a cost-to-borrow perspective. The shorts who are in this trade are comfortable. This is not a GameStop or AMC setup. This is a fundamental bet against the company's valuation, or more likely a hedge against the sector's political risks, risks which just paid off for them. What's your take on the massive 7.9 million shares that failed to deliver at the end of September? Was that a technical glitch or a sign of something more serious in the settlement process? For any investor, knowing how to read this data is vital. You can find the short interest data published by NASDAQ itself or on platforms like Fintel or Ortex. When you see a high short interest number, your next step should always be to check the borrow fee rate and the days to cover, which stands at a modest 2.84. A low borrow fee and low days to cover ratio signal that the short thesis is not under pressure. It tells you that the smart money betting against the stock is not scared. Chasing a squeeze in a stock with a sub-1% borrow fee is a low-probability gamble. The data suggests the fight isn't as intense as the social media forums on Reddit or X, formerly Twitter, might lead you to believe. The narrative online is one of a battle, but the data suggests the shorts are simply placing their bets calmly. This brings us back to the company's core business. With the U.S. hemp market now in peril, Tilray's identity is split. On one hand, it is the #1 Canadian cannabis producer fighting for scraps in a saturated, low-margin market. On the other, it is a rapidly growing craft beverage company, owning brands like Sweetwater Brewing, Montauk Brewing, 10 Barrel Brewing, and Red Hook Brewing. The expectation was that the cannabis business would fund the beer business until the U.S. cannabis market opened. The reality may be that the beer business must now fund the cannabis business, which just lost its most promising medium-term growth catalyst. The company's strategy of becoming a diversified consumer packaged goods company now looks less like a choice and more like a lifeboat. The U.S. craft beer market is at least a known entity with established rules, unlike the cannabis market, which remains a political football. Investors holding this stock are now in a tough position. The Q1 profitability was a huge milestone, proving the Simon-led turnaround had teeth. The company has a solid balance sheet and a clear lead in Canada and medical use in Germany, which is another market slowly moving toward reform. But the bull case for this valuation, a $1.37 billion market cap for a company that just posted $1.5 million in net income, was always predicated on the U.S. prize. If that prize is now delayed indefinitely, or if the market must wait for state-by-state legalization without a federal framework, the path to growth is much slower and more painful. The market is now forced to ask, is Tilray a $1.27 stock if it's just a Canadian cannabis producer and a U.S. craft beer company? The answer for today, at least, seems to be no. Comment below what you think Tilray's beverage revenue will be in 2 years. Will the beer acquisitions be enough to offset this cannabis sector turmoil? Looking forward, the entire narrative has shifted. The expectation was a political one, waiting for safe banking, rescheduling from Schedule 1 to Schedule 3, and eventual federal legalization. The new reality is that a hostile legislative action, the hemp ban, has taken precedence, showing the anti-legalization lobby still has immense power. The best-case scenario for Tilray is that its beer division continues to grow profitably, its German operations benefit from recreational reform there, and it can maintain its Canadian market share while waiting for the U.S. political winds to change again. The worst-case scenario is that the hemp ban becomes law, the Canadian market continues to face margin compression, and Tilray becomes a low-growth CPG company valued like one, which would imply a lower share price. The tension between the company's positive Q1 results and the sector's disastrous political news is what's pulling the stock apart today. The expectation of a cannabis pioneer is crashing against the reality of a political stalemate.